Congratulations on the new role. No, the pleasure is entirely
Thanks for
ours.
having me, Neeraj.
So, Manish,
Thanks a lot.
I've known you as somebody who buys, holds, makes at times long-term, maybe even decadal calls. Is the nature and the fabric of the market conducive enough currently for you to be able to do that?
I would think so. I mean, the style of investing never goes out of favor. I mean, that's also a fact that no one style works at all points in the market. So, long-term investing has its play in the markets, and you got to stick to your style. I mean, if you flip your styles, then, you'll be butchered on all sides. So I think, long-term wealth creation only happens when you have a buy and hold approach. I have practiced that all my life and will continue to do that. And in most circumstances, it does end up creating wealth for investors.
Got it. So is at the current juncture, Manish, assuming that if you got a pot full of money from your investors over the course of the next 1 to 3 months, would you be tempted to deploy it ASAP? Or do you believe tactically, because of all these cues, I mean, geopolitics, there is higher yields, or maybe they've come off a little bit, but still at the higher end, if you will, and crude prices being volatile, would you get tactically better times over the course of the next 6 months to deploy that?
You might, Neeraj. I would believe that next 6 months it's a sideways market.
Okay.
But it is also a great time to build a portfolio from the medium to long term point of view as far as India is concerned. Of course, we are talking about recession in developed parts of the world, but India couldn't have it any better than where we are. I would believe you could be staying within, let's say, a 19,000 on the Nifty to 20,500 on the Nifty for the next 6 months, for the simple reason that dollar index is near its all-time high, oil is on the boil, you have geopolitical tensions, inflation is still a worry, rates are still headed higher, at least as far as one more hike is concerned in the US. So all these things would keep the markets tentative. We could be in for a risk of trade at the moment. So to answer your point directly, could there be a tactical moment to deploy funds at a later date between the next 6 months? The answer could be a yes. But could you time it to perfection? I would believe no. So anytime between the next 6 months, it would be a great time to deploy capital in India.
Okay. Just one more slightly macro question. Do you foresee a point? You've told me already there will be a sideways market. What's the risk to this thesis? Do you foresee that if oil were to go higher because of geopolitics, and that's an unpredictable, right? Or if yields don't come off as much as the market is now penciling in that they might, because the Fed may stay on a pause or what have you, could that open up further downsides, Manish, to the current thesis that you have?
I think all eyes on the US for the moment and the Middle East. If oil is headed higher, then obviously India would be facing a problem. From that point of view, oil at 100 or beyond would be a risk factor. Uh, of course, markets are pricing in a pause after one more hike by the US Fed in December. If that base case is not to be there and there could be further rate hikes thanks to inflation even headed higher, then obviously there is a risk to this thesis. We should all be watching the dollar index. There could be a situation of a dollar shortage globally, and which would mean that there could be risk of outflows from emerging markets. So I think all eyes on the dollar index. If dollar index is not headed higher, maybe there should be inflows into emerging markets, but otherwise there could be a risk to that fact.
Got it. Okay. Now, Manish, let's try and figure out that if you are building out your portfolio sometime over the next 6 months or during the course of the next 6 months, and since you said that you follow the buy and hold theory, and I read your presentation and it speaks about a bunch of themes which are quote unquote decadal in nature. I mean, it might be 5 years, 7 years, 10 years, as the case may be. And there are a bunch of opportunities out there. How are you choosing the first amongst the equals?
So I think the thesis of selecting stocks on a bottom-up approach remains the same. Basically, we want to buy good managements. We want to buy growth stories or growth companies that could compound their profits, doubling every 3 to 4 years, 18 to 24% compounded. These businesses should not face the risk of disruption in the next 10 years. There should be a good terminal value, and we want to be early in the game and not pay an expensive price. So that thesis remains as it is. I think the five themes that we talk about do present a superlative growth opportunity between India's journey from a 3 trillion to a $5 trillion economy and going beyond that. So, of course, consumption is one of them. We are talking about manufacturing, Atmanirbhar, China plus one, Europe one, that being the other. Energy transition is all on us, right from production to generation to transmission, distribution, and consumption. We are talking about artificial intelligence revolutionizing technology going into the next decade. So these would be some of the themes that would be focusing on, and we think that these would be growing better than the market. In the interim, next 6 months, as we believe that the broader markets are exhibiting some degree of froth, but there is greater value in the large cap space. And of course, this is a multi cap portfolio. We would build out the large cap portion of the portfolio first. And of course, being a risk off trade at the moment, we believe that currently IT, pharma, and banks do offer a defensive approach to the markets where there is growth, valuations are very comfortable, and the theme exists for the next 7 to 10 years.
Growth in banks, I understand. Why IT? I mean, we're still in a state of flux if the latest commentary is anything to go by.
One should read beyond 2025, Neeraj. That is when we look at, of course, you could say that, things are still falling as far as the US is concerned. But once the rate hike stops, and after a hiatus, there is a rate decrease, of course, everything comes back on the table as far as the discretionary spend is concerned. And marrying that with artificial intelligence, where that is the talk of the town, where it is about machine learning, deep learning, algos, translating into generative AI. I mean, there could be billions of dollars that come. And what we have seen right from Y2K to, let's say, cloud computing, Indian IT vendors do tend to get a lot of business after a gap. So, when we are talking about, let's say, a 15% sort of a growth, we're talking about, let's say, NASCOM doubling IT exports in the next 5 years. I mean, you could give it a 1 year or 2 years here and there, but that sort of a growth rate is there. And when the PEG ratio of most IT companies on an FY25 basis is around 1 time, let's say the index today is at 20p or 22p, FY25, if one was to get at 20p on any IT company, decent IT company, whether in the large cap or small cap space, I think the risk is to reward is very, very favorable.
Okay. So
that is why I think there is a great time to buy IT, right?
Okay. So I have a follow-up here.
And the entire world is selling IT.
Got it. So I have a follow-up here. One is the top 5 index names, or 6 index names, if you will, and the valuations that they are trading at. Because I heard you say that you want to buy into large caps. The point is the non-index names also in the IT space has stocks which are, or companies which are larger. They may not be mega caps, but they are large in their own right, if you will. And then there's a third bucket of stocks, Manish, wherein we haven't seen too much of a valuation correction because growth has stayed steady, which is the product companies, ERD companies, so on and so forth. I would love to understand where within this 3 do you find the view to allocate capital, and why within these 3?
See, I'm not fixated with Nifty 50 IT companies.
Okay.
That's the point I want to drive at. Within the large cap space, when you talk about, let's say, engineering R&D companies also, we have seen roughly a 30-40% correction. We were trading at, let's say, 60-70p. Today, we may be trading at, let's say, 30p. Of course, the best comfort point would be if they would be trading at, let's say, 20p on an FY25 basis. That's the point in time, whether it be a large cap or a mid cap or a small cap. I mean, that sort of valuation should be the floor. But anything more than that, the growth should be commensurate to those valuations. I mean, that's the point. So yeah, I would believe that larger IT companies and even mid-cap companies, when they come within the valuation comfort zone, would be great opportunity because they would tend to grow faster. And when we talk about the AI theme, it is not restricted to the mainstream IT companies. You could also have small niche IT companies, specializing in AI, and they may be developed outside the mainstream IT companies, and only at a later point in time get into the mainstream IT company. We are talking about all companies talking about generative AI, right? Whether it be the large caps IT companies like TCS or an Infosys, or you have small companies like, let's say, Latent View Analytics and all of that. So I think it all boils down to who grows faster, who has more business, and how valuations stack up. But at this point in time, I would believe large cap IT companies offer greater value when payouts are 100% or more. You are talking about mid-teen valuations on, let's say, a 1 year forward basis. ROEs are not of 20-30%. I mean, that gives some degree of comfort.
Got it. Okay. Just one quick follow-up on banks as well before I move to the decadal piece once again. We have about 6-7 minutes left on this conversation, I understand. Banks, private banks, PSUs.
No, I would go with private banks simply because uh, the PSU banks have come off a low base. They have seen improvement in profitability thanks to declining provisions, as well as, let's say, a very benign credit cycle. Growth is par the course, but the moot point remains that state-owned banks will continue to lose market share in favor of private sector banks, right? Uh, uh, you have a lot of dilution that we have seen in state-owned banks over these years. So when it comes to, let's say, not the absolute profit number, but the diluted EPS, that does not give that sort of a comfort when we are somewhere close to the bottom of the NPA, top of the NPA cycle. I mean, we will see credit cost normalize, right? And I think in the past we have seen that credit appraisal standards, obviously for private sector banks, are much better than that of PSU banks. There could be cyclical plays as far as the PSU banking basket is concerned. We have seen the best part of all that. But on a long-term investing approach, I would think the risk is to reward is clearly in favor of private sector banks and more so the large private sector banks, whether it be the likes of, let's say, an HDFC Bank or an ICICI Bank or a State Bank of India. Of course, that's a PSU bank or an IndusInd. I mean, all of that is basically a bottom-up approach that one can take on individual stocks, but that's how I would approach it.
Got it. Thanks for that, Manish. The other aspect, and we were talking to JSW Energy just before we spoke to you. Your decadal theme has energy transition out there to green energy is a reality. Even the incumbent power companies are making these mega shifts towards green power. But just the beauty that because we are currently looking like a power deficit country, the basic business of merchant power selling as well is yielding them very fantastic EBITDAs. My question is, when you talk about energy transition as a decadal theme, could it be power producers? Could it be transmission companies? Could it be a completely different set of companies? How are you looking at this theme?
Everything is on the table. I mean, we are talking about companies like JSW and Tata Power, where the long-term goals on the megawatts that they are going to add, and mostly out of renewables, would mean that these companies would be a giant companies from what they are today.
Okay.
And of course, all of these means that higher profits, of course, and obviously there'll be a higher balance sheet also, big bloating of balance sheet because they are going to leverage. And that's how giant corporations are born. And as you said rightly, that India is a deficit country. If you are to achieve a $5 trillion economy, we can't be having this sort of a energy insecurity. So everything is on the table, from power producers to transmission companies to distribution companies to cable companies to conductors to switches, transformers. Everything is on the table because there is a mega shift in the energy requirements. Of course, we have already seen that electricity as a proportion of the total energy basket, which currently stands at, let's say, 20%, over the next 10 years would have to move to 40%. And of course, that bigger transition itself presents a humongous opportunity in terms of what you can buy today. And those companies would be what size in the next 5, 7, 10 years.
So effectively, Manish, you are saying that I'm not saying that you are saying that, but I'm just you quoting this, that if, for example, reports say that the JSW Energy, just using the name as an example, might be expensive FY25 basis relative to what it has always traded at. You're looking at what these companies' size could be, let's say in FY30, and therefore you find them to be cheap, maybe.
They would not get cheaper because it's all about the terminal value in the next 10 years. And this theme is not going to reverse. I mean, you have a geopolitical mandate of moving your fossil fuel requirements away from Saudi Arabia and Iraq and Iran. You have a cost advantage. You have signed regulatory protocols. This is not going to reverse. The sooner the capacities get built, the bigger your terminal value gets created over the next 10 years. So it's not going to get very cheap. I don't think so.
Okay, great. My final question, because there are a bunch of things that we can talk, but I love the comment about the prodigal son in that note, and I presume what you're trying to say there is that we are moving from basic consumption to higher value consumption plays, which might actually benefit. Now, even that is a very wide bucket, because there's an uber luxury bucket, which has now gotten formed, to a mid luxury bucket, to a slightly above basic subsistence bucket. Maybe all of them are on the table. What is the favorite there?
So wherever the growth rates are going to be higher, of course, we are now seeing that, a pyramid-shaped demographic structure translating into a diamond-shaped demographic structure where, you will have more affluence in the next 7 to 10 years, or let's say 5 to 10 years. You'll have a bulging middle class. You'll have urbanization come through. You'll have number of internet users go up significantly. The median age doesn't shift too much from 29, 30 years to maybe, let's say, in the next 5, 7 years. You'll have, let's say, a per capita income going up. And you have some segments of the consumption basket or pattern change dramatically. Of course, we have known that the Gen Z millennials way of consuming is very different from Gen X way of consumption. We have seen many new consumption categories come through. I mean, we have seen the live example of food service as a theme, right? I mean, those are mega businesses in the developed world. And here we are just scratching the surface, right? Just about, let's say, less than 1 crore active users on, let's say, Zomato and Swiggy. And these are no different from traditional consumption companies like a Lever, which in 1973, launched a Lux. The consumers liked it, they bought it again, and it became a habit. Similarly, the process of, let's say, habit formation is undergoing currently as far as the food service is concerned. The moot question to ask is whether this habit formation is going to be reversible, and the answer is a clear no. And today, let's say China delivers 1,400 crore order every year, and between Swiggy and Zomato are delivering 140 crore orders. And they are today making, let's say, 22, 23 rupees contribution. I mean, why should the market be staying, let's say, Zomato staying at 1 lakh crores or thereabouts? It could be multiple times of that, as we've seen. Let's say Lever with 60,000 crores, 150 crore people, 400 crores per capita consumption, 25% margin, 100 rupees, net profit, 20% assuming is 80 bucks. 80 bucks per person consumption, that company is being valued at 6 lakh crores. Why should Zomato get valued at only 1 lakh crores where only 1 crore consumers are there out of, let's say, 150 crore consumers? It's a long way to go. The only moot question to ask is whether the habit formation is reversible. Answer is no. This is the Gen Z way of consuming. And there is plethora of examples when platforms are becoming the norms. The traditional pipe way of doing business, you have one end on production and the other end on consumption. No, it's now platformization of the consumption. That is the big theme that we are betting on as far as the consumption side is concerned.
One of the days before the year turns, Manish, we'll try and talk in detail an episode only on the platform piece and how you guys look at it. Delight talking to you today. Thank you for taking the time out.
Pleasure was all, man. Thanks for having me.
The pleasure was ours. Viewers, thanks for tuning in.